Let me ask you something. If I told you there is an investment that's down nearly 50% in the last 5 years, would you believe me if I said it was US government bonds? Yes, the safe and boring stuff your parents and grandparents said was risk-free. That's what we're going to talk about today because the rules of money are changing fast, and if you are not adapting, you're falling behind. So let's go. Let's start super simple. When the government or companies need money, they borrow from investors. And they do this by issuing something called bond. A bond is basically a loan. You lend them money and they promise to pay you back later with interest. So if you buy a US Treasury bond, you're lending money to the government. People call it risk-free because the US government has never defaulted. They can always print dollars, right? That's why bonds have been a favorite for retirees, pension funds, and conservative investors for decades. They are boring, stable, and supposedly safe. But something changed. Let's talk numbers. There is a popular bond investment called TLT. It tracks long-term US Treasury bonds. Guess what? It's down 47% in 5 years. Even if you count dividends, you are still down 38%. That's almost half your money gone. It's not just one ETF. Shorter-term bond funds like AGG have lost money too. So what happened? Two big reasons. Number one, rising interest rates. So when new bonds pay higher interest, your older bonds become less attractive and their value drops. And number two, inflation. Even if you're getting paid back, your money buys less than it used to. So yes, they might pay you back, but in dollars that are worth less and less every year. Now here's the fun part. Let's say you invested $10,000 in bonds, i.e. TLT. You would now have around $6,181. If you invested in Bitcoin, you would now have over $117,000. Yes, Bitcoin is risky. It's volatile. It crashes and rallies like a roller coaster. But when you compare both on a risk-adjusted basis using a measure called the Sharpe ratio, bonds stand at 0.3. Bitcoin stands at 1.0. That means Bitcoin gave you more return per unit of risk. And this isn't just about chasing gains. It's about protecting your purchasing power. Because if bonds don't protect you from inflation, what's the point? Here is the bigger picture. The US government is running massive deficits. So is Canadian government, which means they have to borrow more money. More bonds. But people are not buying unless they get higher returns, which is why you will see the long-term yields on the bonds tend to stay higher. So the interest rate goes up and the bond prices fall more because they are inversely related. Meanwhile, smart investors are looking at assets like gold, Bitcoin, and equities tied to the hard money. And this brings us to a new trend, which is Bitcoin treasuries. What if you want Bitcoin exposure without actually owning Bitcoin? That's where Bitcoin treasury companies come in. These are public companies that hold large amounts of Bitcoin on their balance sheet, kind of like digital gold vaults. Some like MicroStrategy are basically a Bitcoin ETF in disguise. But here is where it gets interesting. You cannot judge them using old school metrics like PE ratio. You need new tools like Bitcoin per share or BPS, Bitcoin yield, multiple of net asset value, and most importantly, the FIT score. The FIT score tells you how closely does this stock track the Bitcoin price. If it's over 80%, it's a pure play, just like MicroStrategy. If it's under 50%, it might be a company that just happens to own some Bitcoin, but it's not their core business. That is the key difference. Here is the exciting part. Most big institutions cannot invest in these small cap Bitcoin companies. Too small, too volatile, too risky on paper. But you, my friend, you're early. You can find companies with market cap under $1 billion, FIT score above 80%, and Bitcoin yield over 1%. That's your 10x potential. Because before institutions can buy them, retail investors have the first crack. It's like getting into Netflix in 2007. Now, this is not a financial advice. I'm just sharing you what I'm learning on internet. So here's what I suggest. Learn how bonds, inflation, and Bitcoin really work. Join our community. We talk about this every day. Focus on risk-adjusted returns, not just hype. Start tracking FIT scores and Bitcoin yield on Bitcoin treasury stocks. We are living through a shift, a monetary revolution. The old safe investments might not be safe anymore. And the new world, it belongs to those who understand the system behind the system. If you found this helpful, drop a like and subscribe and send this video to someone who still thinks bonds are boring but safe, because safety isn't about what's popular. It's about what actually protects your future. See you in the next one. I just wanted to let you know that I also offer one-on-one consulting calls to the individuals who are looking to discuss their financial planning, their investment strategies, their kids' education planning, their immigration moves, as well as the young professionals, because I have been in the tech industry for almost 20 years. So I also offer one-on-one consulting calls to the young professionals who are looking to have their career development discussion with me, and also personal branding as well. So if you are looking to have some sort of an expert opinion, there is a calendar link in the description below. Book a 30 minutes call with me and I will be more than happy to help you out.